everyone. Welcome to the show.
All right. Welcome to the show. You know what today is?
Sunday.
Sunday, yes. You know what the date of Sunday is?
No.
October 1st. It is officially Q4 2023.
Oh, yeah.
Yeah.
October 1st.
Time flies
We
when you're
don't
having
know.
fun.
We don't know yet, as we're recording this, whether the government is shut down or not. We don't.
Oh, right. Well, it's Friday afternoon, so we have until tomorrow midnight.
Yeah, figure that out. So we'll know once this comes out, but we won't be talking about that today. We might be talking about it next week.
We might talk about it next week. I mean,
who knows?
My personal opinion is that the market, they're going to say the market factored in already, no matter what. And there's no ambiguity here, right? Either the government shuts down or it doesn't, and there's not going to be any like black swan event, right? It's either it shuts down or it doesn't, and I think the tendency for I think the market thinks it is going to shut down, which is fine. It's already priced in, which is fine.
Yeah. Yeah, I mean, it is a unique perspective when this happens nowadays for us, for me, not being in the government, right? We're done with that, but you know, we still know so many people that are, and I was talking to someone this morning, and they were like, "Oh yeah, I'm going to work today to learn how to do an orderly shutdown,"
right?
And they're like, "Unfortunately, I've done this before, so I don't really need to be told how to do it." And it's kind of funny though, not funny.
There's never, as we know, there's never an orderly shutdown in
they all got to figure
agency by agency because it's all a goat rope every time you try
got
to
figure
do
out who's essential,
and
who's not, and what contractor is going to get paid. I hate it for folks that are still in the game. Most everybody listening to this because it's just anxiety and stress that you shouldn't have to deal with. So it's unfortunate. Yeah. Hopefully it didn't happen. We'll know by Sunday when this airs.
What was
I just wanted to mention that because if people were like, they didn't even talk about it.
Yeah.
It's because we record this on Friday evenings.
Was it 2014? Was the last big one? What was the?
I can't remember honestly. It had to be because I retired in 15. So I do remember. I think that's the one where we actually furloughed people and.
Well, that was the one where if it goes beyond 2 or 3, is it 2 paydays or 3 paydays? Then like all kinds of things trigger.
Weird, bad things happen. Yeah, I remember that. I remember people coming off leave and all kinds of weird things because they were getting conflicting information and they're like, if you're not here at work, it turns out like everybody was getting paid anyway, no matter where you were and what was happening. At least in our agency, I don't.
Well, part of the problem was that if you miss 2 paydays, now you can't make a mortgage payment. Right, and it's things like that.
Bad things happen.
Right.
Yeah.
Once you miss 2 paydays, you got a big problem.
Well, hopefully none of that happens. Knock on wood.
With all the geniuses up there on the hill, I'm sure it won't happen. All right.
There's so much sarcasm that just came out.
Dude, it's been one of those weeks.
Yeah, no.
And
what do you got for what?
It's probably not bourbon. It's probably not. Oh, probably is bourbon. Yeah.
Probably you too. Probably not.
Probably not.
What do you got for us this week?
All right, Ben? This week, all big picture stuff. There's a lot of day-to-day stuff going on in the market. We'll get to a little bit of that at the end, but in the big scheme of things, you really got to be watching these 3. These are the 3 things that are when they change. That's when the market's really going to change. I don't mean a day-to-day, even week-to-week basis, but when these 3 things change. Then you'll really see a substantial collapse in the market. And then the bonus chart is going to be DBC, which is a sort of a basket of commodities indexes. And then we're going to take a look at the C fund, a couple of charts on the C fund. So the DBC came from a request that we had. Hey, can you please do an analysis of the DBC index as a bonus chart? I think commodities will outperform during a recession. I don't know about outperform during the recession, but I think they will be the ones that will lead us out of the recession. So I'm actually looking at commodities really closely, and usually in a recession, everything gets sold initially. At some point, you get to some kind of a bottom, and the things that are going to lead us out of it do it. And I agree that commodities will be the thing that leads us out. But I think there'll be better times to buy commodities going forward as we get into this recession. But we'll talk about it when we get to that chart. Unemployment. So until people start losing their jobs, the market is not going to crash in the big scheme of things. Okay, that's as long as you. I was actually just talking to a buddy of mine a few minutes ago. He's a realtor, and he says, we're going to be in this environment for like the next year. I'm like, absolutely not. We're not going to be in this environment for the next year, because he's like, there's no houses for sale. He's doing some big percentage less than what sales volume than what he was doing last
we
year.
were talking about it on the way here. I mean, I'm always looking at the market around here, and there's nothing on the market.
Right. So he's like, it's going to be this way for at least another year. I'm like, no, it's not, because at some point the rates, which I think are they're higher than my Elliott wave projection of rates as it is, by a little bit. I thought the 10-year yield would get to about 4.5. It hit 4.7 pre-market this morning. But if we get up to 5, I mean, Jamie Dimon was saying we should, in the summer, in May, he was saying we should be prepared for like, it was either 6 to 7 or 7 to 8% 10-year yield rates. I mean, at some point, the rates are going to be so high that something breaks, and the Fed, the market tanks. The Fed drops rates. It happens all the time.
They go to stimulus mode.
Right. They go to QE. Rates fall.
Yeah.
And how that affects the housing market, which is what I was talking to my buddy about. Like, I mean, everything's fine until you lose your job. So
Right.
So
all that is important until you
right.
If you lose your job, if you're one of the people that lose a job because of unemployment, because companies can't. Because we talk about this all the time. We've talked about it in other shows. When the interest rates go back up, somewhere in here, there's a crunch to where companies that are over leveraged,
Yep.
particularly if you're leveraged enough, if you're paying your payroll
on debt,
man, you're in trouble right now.
You're in big trouble.
And because you can't sustain that. At some point, I don't know when, that'll break, and unfortunately, those companies will start to lay a lot of people off. And we like, I hate saying this out loud because it always sounds like really douchey, but if you built your company that way, I'm sorry, and I hate people that are losing their job, but the company needs to fail. They don't need to be bailed out, right?
Right.
That company was operating inefficiently,
Yep.
poorly. I feel bad for the people. If you work for, we don't have a lot of private sector people watching this show, but if you
if you're working for a zombie company, you
go
need
find
to really
go find someplace
think about
else
what
to
you're
be.
doing.
Yeah, if you're working for a company that's over leveraged, if they're paying payroll out of debt, that's a bad sign, especially in this economy, because they're going to fail at some point.
Yeah,
that's just the way it works. But you're right. People start to lose their jobs. That's when it really starts to hurt, right? Because it doesn't matter if the housing prices come down and the interest rates come down or anything like that.
No,
if
you don't have money.
You don't have a job. You can't do it.
So as far as the market goes, if you don't have a job, what does that mean? You're not contributing anymore to your 401k.
Right. Yeah, they're definitely.
Right.
Yeah.
How much we talked about it within the last couple of shows. How much? So Apple, I think, is about 7.5% of the S&P 500. If unemployment goes up, Apple's not getting their 7.5% of the S&P every 2 weeks, every payday, right?
Yeah.
If you're contributing to the S&P 500, 7.5 cents on every dollar is going to Apple.
Mm-hmm.
If a bunch of people get unemployed, Apple's not getting their money, their stock goes down. So so you flip to the chart there.
Mm-hmm.
So here we are at the St. Louis Fed. Okay, this is a great website. It's fred.stlouisfed.org. You can find all kinds of really cool information in there. But I just wanted to kind of point this out. So the gray in sections in here are recessions. Okay. So every time unemployment ticks up, the recession begins. Unemployment falls, the recession ends. I mean, every time.
You can call that a correlation.
There might be, it could be a correlation. It doesn't mean it's a causation, but it's certainly
correlation.
All we need is a correlation, right? So, we're going back to 1950. Bring it just up to present. Like the recession in 1990, we had a pretty stable employment number, and as soon as it ticked up, we're in that recession. 2000, as soon as it ticked up, we're in the recession. Same thing in the crash in 2007. COVID was very unusual because obviously unemployment ticked up to basically 100% because nobody was allowed to go to work in the government's infinite wisdom. It's going to be one of those shows, I think. But the point here is we have not seen an uptick in unemployment, right? So once we do, if we start seeing this thing curve up, that's the beginning. That's the beginning of the recession, but we are not there yet. Okay.
And there's a lot of factors as to how long that lasts, right?
Yep.
So, because I don't particularly, want to impart fear in people that, oh my gosh, if a recession happens, all is doomed.
No, as long as you have a job, you're fine.
Because you can look back and see where it does happen. Recessions happen. We go through. It's part of the business cycle, right?
Yep, 100%.
It's in there. Deflation, inflation, all of it's in there, right? So here's the thing. It kind of matters how long it takes and how abrupt it is, either in or out. Both those things matter too, right? So how fast we get to the top and how fast it comes out of it. You'd kind of think like, you look at the chart there with the with COVID, right? Huge spike, comes back down. Not necessarily. I don't think that's what you really want. You want it to be kind of gradual in and out, but you don't want it to take too long.
Well, I mean,
right?
COVID was a flip of a switch,
Yeah,
so it's a little bit different.
It's just not gonna. That's not normal. No. So you take that out of it. But I just saying, like, because you can look at some of those the peaks and valleys. Let me go back to the chart. And you can see some of them, the recession lasted longer, right? Anyway, my point here is that the hope is the other things work the way they're supposed to get us out of it just about as quickly as we got into it. And so really, in the big scheme of things, it's a blip on the radar. And hopefully you have a job during that time.
Yep.
I think you will if you're listening
to this. If you're a government employee, you're probably in pretty good shape. Yeah.
Because
you might be lucky enough not to go to work and still get paid, but...
Yeah, exactly. I mean, honestly, like, that's probably more likely than not having a job, is not having to work but still getting paid. Yep. But yeah, hopefully nobody listening to this is losing their job.
You're totally off the track a little bit, but there are a lot of remote employees now, government employees. So I wonder if, the reason it kind of went remote was because of COVID. So if you're in a shutdown and you're remote, I guess you just won't be able to work from home. You'll be at home, not allowed to work because because knowing that you're going to get paid later for not working, but you're still at home. Yeah, I need to go back to the government.
No, we don't. No, don't
I'm
say
gonna talk
that.
myself into not what I was doing before, but
I was just talking to someone last night, and they were like rolling the dice, praying for. They called it in their agency like the blue gold or AB or something like that, where basically half the force comes in and half the force to go back and forth. A little bit because of COVID and a little bit because of this. It's like they're talking about maybe we go back to that, because that was like the perfect world, right? They were getting paid but had every other week off, and I was like, only a government employee would be wishing for this.
That's a submarine terminology,
Is it blue gold?
Boomers, big submarines. There's a blue crew and a gold crew, and they flip flop. So that's where that comes from. Yeah.
Okay. I call it shamming.
The Navy guy knows that. All right. So that's what it looks like from the Fred. If you look at it, unemployment compared to the S&P 500, right? So this is the same. It's the same Bureau of Labor and Statistics information that we were looking at on the Fred, but this is on TradingView. Okay. So all I did was put the same chart up top that we were just looking at over the S&P 500 right here. So it gives us a little bit of perspective for what happens within the markets. So obviously, at the peak of unemployment, you would expect it to be at the bottom of the market, right? When unemployment starts to go up, the market starts to roll over. When unemployment starts to go up, the market rolls over. I mean, it makes sense, and it just works. You could argue, beginning to see a rise in unemployment. So 3.8. I'm saying if we get above, so this is the 4 line that you can just kind of barely see it, but that's the 4 line. If we get above 4, I think the eyebrows are going to start to raise. I don't think it's going to cause any cataclysmic, rollover, but I think that's going to be the beginning of the upturn like this. Once we get to 4, people are going to look at this as an upturn. Right now, they're just looking at it as a flat. And if that happens, unemployment goes up, S&P 500 goes down. It has not happened yet. Yield curve. Everybody talks about the inverted yield curve, right? So same St. Louis Fed. So this is the 10-year yield minus the 2-year yield. Okay, that's so basically the idea is if you're lending the government money for a long period of time, 10 years, you should expect a better rate of return for that loan than if you're lending it to them for 2 years, right? Just it makes sense intuitively. If I'm going to tie up my money for a longer amount of time, I should expect a higher rate of return. When the economy is psychotic like it is now, the 2-year yield is higher than the 10-year yield. And that's how you get an inverted yield curve. That's what that means. So it doesn't happen all that often, but it always precedes a recession. So the inverted yield curve, once it inverts, it doesn't mean a recession's happening tomorrow. It's putting you on radar because it's coming. So it can be a pretty long time, right? So really the trigger isn't that the yield curve inverts. The trigger is when it uninverts. So here's the one example. We inverted, uninverted, and then we're having this recession in the early 1990s. 2000, right? Here was the top in 2000. Yield curve uninverts, and the market crashes, as we know, and we have this recession. 2005, the top in 2007. Yield curve uninverts, market tanks, recession gets announced. COVID, long before COVID, this is the most interesting thing. This is what you'd have to be really wonky in the history books to pick this up, but we had an inverted yield curve in 2019. There are all kinds of stuff that we could talk about, but we were going to have some kind of problem in the market before COVID. Whether we had COVID or not, we were going to have a big problem in the market, and it collapsed because of COVID. And then it got recovered because we did ridiculous amounts of QE to stimulate everything back up. But we were going to have a problem. It probably would have been in 2021 or 2020 into 2021, but COVID obviously changed the whole thing. But so now we get inverted again, and we've been down. This is the lowest inversion, obviously, since back to 1985. If you went back further, this is the lowest inversion in a really long time. We've started to uninvert. It's not a big deal until you get back above, and now you're actually uninverted, right? This is when we're going to have a big problem, and we still have a ways to get there. So it hasn't happened yet. Just like unemployment, the yield curve inversion has not uninverted yet, and therefore we're not having this stock market collapse, and we're not that close to a recession because it hasn't inverted that much yet. And then this is what it looks like if you do it on TradingView. So this is the zero line. Here's where we uninvert in the 90s, and we have this. I mean, it's hard to see on this kind of scale, but this is the pullback. Yield inverts, uninverts here. And we have that collapse. Uninverts here, we have the collapse, right? At some point, so we're starting to uninvert, or we're in the process. Once we get above that zero line, market goes down. Okay, but we're not there yet. No idea how long it's going to take to get there. But these again, this is not a timing tool. This is the big picture. And in the big scheme of things, the macroeconomics cycle is setting us up for a big pullback in the stock market. Last one, credit spreads. So if you've heard the term credit spreads blow out, I'm looking for the credit spreads to blow out before I really start to reallocate assets and stuff. It happens before recessions. So here's 2000. Credit spreads start to move higher, and they keep going, and then we have the recession. 2008, they start to move higher. We have the recession. They started to move higher before COVID, not that long before, but it was before COVID. So something was happening in credit spreads before COVID actually happened. But again, and this is what, if you listen to Bloomberg at all, people are amazed. Credit spreads are not blowing out, right? Even given this was 2022. Here's the beginning of 22. So yeah, did credit spreads move higher? And you could say that's what that move in credit spreads is related, if not causated, to the decline we had in 2022. Yes, it's possible. But in the big scheme of things, this little move is not credit spreads blown out. This is, right? This is. So if we see credit spreads start to spike, stock market goes down. And this is what it looks like going back to 1997. Credit spreads start moving higher. Where am I at? Credit spreads is black. S&P 500 is orange. Credit spreads spike right there. S&P goes down. Credit spreads spike. S&P goes down. 2018 was an interesting. 15 to 18 was really interesting. Credit spreads start moving up. We had this whole big thing in 2015, and then 2018 was another one. Credit spread spike. Market goes down. COVID, obviously, big spike, big move down. We didn't have a big spike really in 2022, but that was enough to have this kind of sell-off that we had. But right now, credit spreads aren't moving, right? So yeah, we've had this little decline since July or whatever. But in the big scheme of things, credit spreads have not started to blow out. If we start getting a big spike in credit spreads, market goes down. So those are three really critical, big picture charts to keep on your radar. Okay. Bonus chart. So DBC is the Invesco DB Commodity Index Tracking Fund. Invesco does a ton of different funds, and a lot of them are commodities based. And DBC is like a basket. DBA is just agriculture. DBB, I think, is materials, maybe. I don't know, but it's worth taking a look at to see what different funds, especially in the commodity space. But DBC is like a basket. So, and this is pretty interesting because here's 2007, right? That was the top of the real estate or global financial crisis, right? So the bottom was in March 2009. So during this time, the stock market is tanking, and commodities are soaring, right? To a certain point, which was in 2008. And if you, I didn't do an overlay of the chart. I probably should have, but in 2000, there was a big difference between what happened from the top in 2007 until I can't remember where exactly, at the end of 2007, beginning of 2008, of the financial crisis. Everything sold off together, and this is what I meant when commodities can do well, but everything when you're in a real like bear market recession, everything sells off. And so I don't want to miss this, but I definitely don't want to be in for that. Coming out of the recession, in this case, commodities didn't really lead. I mean, it went higher coming out of the bottom in 2009. But I can't remember what actually led back then. But commodities wasn't bad, but it was a corrective move. It was an ABC move. And once it peaked out, it started to come back down. Couple interesting things I wanted to point out on this. We talked about head and shoulders topping patterns for a while. 14. Okay, 14. Left shoulder, head, right shoulder. Takes from 2017 to 2020. So 3 years to create this head and shoulders topping pattern. And then what happens? The neckline gets violated. So 14 is the neckline, right? Gets violated. The top is 18. The neckline is 14. That's $4. How far, what's the projection on a head and shoulders? What's the downside projection? It's the same length as from the head to the neckline. It's $4, right? From 18 to 14. So where would we expect the market or the whatever security we're looking at, where would we expect the bottom to be? 10, right? Same length. And there you are at 10. Right? It's a great example of a textbook head and shoulders pattern. Okay? So we bought them at 10 in 2020. Commodities take off. Big move down. ABC correction. Right? It's not an impulse move, it's a corrective move, ABC. This 1, 2, 3, 4, 5. That's an impulse move to the upside. This is a corrective move to the downside, which means this correction is correcting this impulse move to the upside. So what happens after that? 1, 2, 3, 4, 5. So this is where I don't think, I think probably one A, B, C, right? Because this is the recession that's coming. So I think commodities go lower. I don't think they keep going higher from here. I think in the recession, they sell off and we get an ABC correction, which corrects this move. And then after the recession, commodities explode to the upside. That's how I'm looking at playing commodities. That stuff is going to go, this kind of analysis is going to the dark side, the subscriber side, starting next week. I'm just saying, if you guys are watching this podcast, you might see some differences on the podcast going forward. But that's how I'm looking at commodities, and you can definitely do that in the mutual fund window. And if you kind of drill down into it, this is sort of a little bit closer view of what I'm looking at. So this was the bottom in 2020. We have this 1, 2, 3, 4, 5. We have this. I think it's going to be an A, B. Who knows where B finishes? C, and then we move higher. That's what I think it looks like in the longer run. In the short run, this is a really nice pullback to that 38% retracement level. So what happens here, right? If we get above, if we get back up here and get above this high, then it's wrong. Then it's just going to keep moving higher. And this was the full correction. But I think we get another leg down first. All right. Hopefully that was good for the person that asked that question. C fund. Just I want to do a couple things on the C fund real quick. So this is a weekly chart of the C fund. We got the 20-week moving average line. Okay. We're going back here to 2018. This is the easiest way to look at it. So from the low in COVID, we get above that 20-week moving average line. The 20-week acts as support all the way along until it doesn't, right there in January 2022, right? But even beyond that, there are overshoots, but it acts as support most of the time. What you don't want to be in this case the C fund when we're below that 20-week moving average line, because that's when bad things happen, right? But most of the time it's above that line. And so where are we right now? Last week we got a sell signal on a weekly basis on the C fund because we closed below that 20-week moving average line. Okay. This week it was another down week. It didn't collapse down, but it was another down week, so we have another data point below that 20-week moving average line. And if you go back and look at the chart, there aren't too many. I mean, there are a couple weeks in here that you have 2 weeks below the 20-week. There aren't a lot of places. This is a very bad look. You got a high, a lower high, a low, a lower low, and 2 weeks below the 20-week moving average line. It's just not a good look. It doesn't guarantee anything. It's not a good look. That's a weekly perspective, okay? Here's a daily. So now, this is a 200-day moving average line. Okay, it's not a 20-day, it's a 200-day. Almost all the time, so we're going back to 2012. Almost all the time, the market is above that 200-day moving average line. Right? For the majority of the time, it's above it. When it's below it is when we have these corrections. You don't want to be in the C fund on a daily basis when we're below that 200-day moving average line. But most of the time, when it comes down and hits it, it's getting support, right? Most of the time, when it comes down and hits it, it's getting support at that 200-day moving average line. And so where are we right now? We're literally right on it, okay? So that doesn't mean, what does that mean? Does it mean I should buy it or I should sell it? We are right on the line. History tells you you get support at it. So you take that into consideration when you're making your personal reallocation decisions.
Right.
Right?
If you're only using that chart and nothing else, you probably got to let it play out.
Yeah, you have to let it play out. So here's the last one on this. We drilled down really, really close, okay? This is still the 200-day moving average line. And all I did was draw a line from the top, the most recent top, to this bottom. And in TradingView, I did what's called cloning. I cloned this black line, so it keeps the same angle and the same length. And I moved it over to the most recent top. And lo and behold, it takes you right to that 200-day moving average line. And what happened? Price stopped right at the line, right? So people say, how does this technical analysis stuff work? That's how it works. You can project where you expect, so A, B, C, D. AB equals CD, right? If AB equals CD, we should expect to get support there. That's one piece of it. You overlay that on top of the fact that it's at the 200-day moving average line, and you should expect support there. And we got it. And we've had it for 1, 2, 3, 4 days. Which way does it go? I have no idea. But your risk to buy into the C fund here, your risk is really low because history tells you that you have all this support here, right? And if it closes below it, you sell it. Why? Because history tells you don't want to be in the stock funds when it's below that line. That's how you use this to try to make decisions. So we're not telling you what to do with your money. We're telling you how to use technical analysis to make decisions, right? And that's how you do it.
Yeah. I mean, that's the simplest version, right?
Yep.
And then what we do, if you haven't seen the show or listened to all the things that put out, the content that we put out, we use a lot more indicators than just that. Why? Because we want to get as high a probability of a trend change as we can get.
Yep.
And so that's what everybody's hunting. If you're doing technical analysis, you're looking for indicators that are going to give you a heads up that something's about to happen. And then you want enough of them that you can confirm the trend change fast enough to take advantage of it.
Right.
You can't guess, right? So don't misunderstand that. We're not guessing that it's going to happen. We need to confirm it quickly. And so once it happens, we want to know that that's what happens so we can make the decision to either get in or get out.
Right.
And so that's what, that's where you kind of tighten your group up. So this is a very simple version of that anyone could do. Anyone that's watching this could do what Jerry just explained.
Yep.
You don't need anything else. You can use that technique to manage your retirement for 30 years, and you're going to fare reasonably well. Now, if you're trying to be on the right side faster and more often, then you got to add a little bit more to it.
Right.
That's the difference.
Go back to that chart one. I just want to put out one more thing. So these candles, this is a daily chart, right? So the candles, the top of the candle is where the price opened. The top of the rectangle is where the price opened that day. The top of the wick is that little line at the top right there. That's the highest price that it got that day, right? So it opened at the top of the rectangle. The lowest price it got that day was the bottom wick, okay? So price opened up here at 9:30 this morning. So it looked like we had this huge gap up in the morning. So at that point, you're like, oh, the market's going to keep going higher. It gapped up, it's going to keep going, right? Not so fast. Because at some point during the day, we got all the way back down to almost the low of yesterday. And then we pulled back up a little bit. There's a lot of churning going on there. So that's why if you're looking at daily charts, there's there's no value really in looking at it during the day. If you're day trading, intraday trading, then that's different, right? You're looking for what's happening within that candle. But if
You can't intraday trade the TSP.
no,
Let's just be clear, so anybody doesn't misunderstand us. Like, that's not possible. You can
Right.
do that on, outside of the TSP in a brokerage account, but you're not doing that in the TSP.
right, which is another what that goes to is this noon rule. Okay, if you are looking, if you're looking at this and you're going, okay, I see the ABCD, I see the 200-day moving average line, and then it gapped up in the morning, so I'm going to buy it because I have to make a decision before noon. And the backside of this candle happened after you had the ability to get in to buy it in TSP. So you could look at that and say, okay, that's good. I got a better price,
Right.
which is true. Or you could look at it and go, oh, I shouldn't have done that because it rolled over as soon as I did it, right?
Yeah.
And of course, your line in the sand is going to be that 200-day moving average line.
So the takeaway from that is, if you're going to use daily charts, you have to wait to the end of the day
Yep.
to decide what you might do tomorrow.
Yep.
That's really the best you can do given the circumstances. So there's no real value in looking at this throughout the day.
Nope.
Other than just being curious, right, at what the market's doing.
I might do that once in a while throughout the day.
Yeah, you might do that every second of the day. But, it's not your day job. If it's not your day job, there's no value in looking at that. The value is looking at it at the end of the day. It's almost like if you're looking at this at a weekly, there'd be no value at looking at it day to day, right? So we're intraday for a day.
Yep.
And intra-week for a week. There's no value there. What you would do is wait till the end of the week to decide what you're going to do next week. If you wait to the end of the day to decide what you're going to do tomorrow, that's the best you can hope for.
Yep.
It is, right? Because it's just the rules. If you could make the call right before closing, that would be a little different.
Which you can do in the mutual fund window.
Oh, absolutely.
But yeah, on the core TSP.
But still, making sure you confirm what happened. It's really the best you can do to wait to the end of the day or wait to the end of the week. Whatever time frame you like to work in, whatever makes you feel comfortable, you kind of have to let it play out, and you have to let it wait till the end of that time period to make the decision for the next time period.
Yeah.
If it's daily, you got to wait for tomorrow. If it's weekly, you got to wait for the next week. We do this all the time, and it's about the best you can do, best you can hope for in TSP. But it also I don't want that to sound negative. Like it's a good methodology, as simple as that is. We say this all the time, and we say it all the time because we never know when you're going to watch this show or when you're going to run across our content. But you can literally manage your entire retirement just that way, and you're going to be more successful than people that just don't do anything, right?
Mutual fund window. I forgot. If you are looking at the ticker symbol in the mutual fund window that corresponds to the DCB.
Mm-hmm.
Mutual funds only have net asset value, which means end of day closing price. They don't
You
have
don't get intraday anyway.
There is no intraday. So if you wanted to look at, say it's 3:00 in the afternoon, and you want to decide whether or not I want to sell my commodities index in the mutual fund window today, you have to look at DBC. So it's not going to be exactly the same. It's going to be very, very close.
Yeah.
But if you want to know what's happening intraday, you have to look at indexes or ETFs or something
right
like that.
that are basically mimicking or
Yes.
they're not identical.
It won't be identical, but it'll be very close.
They're very close.
All right, I think that's all I got.
Questions. Again, if you have any questions, not again, but as always, if you have any questions, please send them to support@growmytsp.com. The support team will get them to us. If it's something we can answer, we will take a crack at it. So a lot of times it ends up on the show.
Yep.
If anyone's watching who watches regularly and notice something is missing, it is. We're not going into all of the funds anymore. There's a lot of reasons for that, but most of the reason is, to be honest, it's what people pay for.
Yeah.
It's on we have a subscription service that really digs into this, that goes way more than the weekly charts. If you are interested in that stuff, it's very available and very affordable for you to go take a look. And we deep dive every week in our newsletter into all the analysis of all the funds and all the things that are affecting the funds. And so
growmytsp.com.
That's it.
Sign up.
All right, guys. Hope you had a great week. Hope hopefully things are going well with the government shutdown. We'll find out when we do the next
we'll
show.
Find out. I think next week's going to be the monthly charts because it's the end of the month, and monthly charts. I don't know that we've ever done them, but they're
You do them occasionally, but it's rare. It's rare.
I need to get. I should do them the first week of every month.
Sounds like a plan.
Yeah, might be a plan.
All right, guys, have a great week. We hope the best for you.